Welcome back to another week and Mondial's Making Sense of the Markets, where we try and figure out what's going on in the markets for you to try and help you out. This week, a slightly different format. We've got 4 questions, 4 charts, and 8 minutes of discussions. This week, Sean's with Phil Smeaton from Sanlam Private Wealth. After graduating with a first-class honours degree from Oxford in mathematics, Phil has been in the industry for the last 20 years. Since 2014, he's been with Sanlam Private Wealth UK as the Chief Investment Officer and also as the lead fund manager for the VAM DFM Funds. A proven track record in neutral-only hedge funds and also global-only long funds. So let's see what he has to say.
Given that in recent times we've been through the global financial crisis, now the pandemic crisis, Phil, what is your investment strategy for riding through uncertainty and uncertain times?
So markets are always uncertain, and people say that markets hate uncertainty. That's not really true. Markets are designed to deal with uncertainty. The way that they deal with uncertainty is through lower prices to compensate people for the extra risk of that uncertainty. But that's what they're designed to do. Now, different companies can be better or worse placed to deal with uncertainty. If you're a strong, resilient business with a business model that can adapt if needs, with a prudently managed balance sheet, and with products and services that people want to buy, then you're always going to be in a really good position to survive whatever the market throws at you. Additionally, when things start to recover, you not only survive in the tough times, but you thrive in the good times, because what happens is other companies that weren't so well positioned, that weren't well managed, they struggle, and the good companies can either steal their customers and take market share, or they can buy those companies outright. So good quality companies that have strong balance sheets are just really well positioned to survive whatever is thrown at them. And I think that's a good strategy to ride out uncertain times.
What happens to our clients' wealth if interest rates go negative?
So a lot of people are cautious and they save their money by accumulating savings accounts in banks. And since 2009, they haven't really had any interest paid on that. So that avenue of saving has really been taken away. Now, a lot of people have moved into the stock market, have moved into the bond market to try and generate some returns to preserve their purchasing power. But there are still some people who like to stay in cash and have that security that the value can't go down. Now, negative interest rates is where instead of the bank paying you money, you have to pay the bank money for the privilege of having an account. And of course, what this means is that steadily and slowly over time, you will lose money not just in real terms through the purchasing power loss of inflation, but also in nominal terms as your balance shrinks. We now have negative interest rates in Switzerland, in Denmark, and in places in Europe. So this is in motion, and the fear is that it might come to the UK or the US. Now, unfortunately, this policy is designed to force people to take investment risk, and they have the choice of taking investment risk or of remaining with their money in a bank and seeing that balance dwindle slowly over time. So unfortunately, it forces you to take investment risk. One of the things that you can do is that any goods and services that you were going to purchase anyway, if you can purchase them in advance, you can stockpile up on those goods. So all those people that have been buying baked beans and toilet roll recently, that is a form of saving, and it's a real form of saving that you can do.
Given the attention given to behavioural science within investment, how do you feel investors should react to crisis?
By the time most people realise a crisis is happening, it's normally well underway. The first indication you get ordinarily is widespread coverage in the TV and also widespread coverage of the fact that market indices have normally fallen quite precipitously at that point. For someone who's managing money, there is a small window of opportunity that you get in order to adjust your portfolio and to reflect whatever new information has come out. But that passes pretty swiftly. You find that soon the markets are down 20%, maybe 30%, and you're faced with some tough decisions. Now, at that point, it's nearly always better to become a buyer and look to take advantage of the opportunities rather than trying to protect. If you protect your portfolio by reducing risk and selling out, you might avoid some of the drawdown that will happen from that point, but the most likely thing that will happen is you will avoid nearly all of the upside. If you sell out in March, thinking, okay, I'll buy back a month later when things have calmed down, you would have found that you would have missed some of the upside already and you'd be buying at a higher point. Now, nothing would have changed. We've still got all of the difficult path to walk. All that had changed is that prices had rebounded slightly at that point. Most people who had sold out in March probably wouldn't have invested back in at all. They'll be waiting for some pullback. They'll be waiting for the market to retest the lows or some sort of technical indicator that they hang their hopes on. And as the market roared away, they'll be left with a really tricky choice. And they would have just locked in that permanent loss of capital, having sold out at the bottom. So how to react to a crisis? You've got to get your game plan in order. Adjust your portfolio exposures quickly at the start, but recognize that that window is going to close fairly swiftly. And then become a buyer. Look for the opportunities. Look to see, can I deploy some capital? Are there opportunities there for me to invest in? And try and get into a buyer's mindset rather than one of a seller.
How do you protect our clients' wealth against future inflation?
Well, wealth is the ability to purchase goods and services that you want. And for most people, if you want to take out of the pot of goods and services that the economy produces, you first have to put something into that pot. And currencies obscure this, but purchasing power comes from production. So if you own productive assets, you own wealth. And that's why investing in the stock market can preserve your wealth even in inflationary times. The government can issue new currency and can use that to sort of dip into that pot, but it can't take away the value of your production from owning real businesses. Now, what it can do is it can tax those businesses and it can take it that way, but it can't take it through inflation. The last time we had any meaningful inflation in a developed market was 1960s and 70s in the US. And what you saw in that period was holding a diversified basket of companies did protect your wealth. Okay, at the end of the period, you could buy as much stuff as you could at the start of the period. However, the process of inflation is quite insidious for companies because it distorts pricing signals. You find that a lot of companies make mistakes along the way. They make investment mistakes, and this can create quite a rocky ride in the stock market. So you might see pullbacks of 30%, 40%, and this volatility is unfortunately the price that you have to pay to preserve your purchasing power in the long term. So the good news is equities preserve your purchasing power, but the bad news is it might be a rocky ride, so you will have to hold through that and understand that at the start.